Okay, so the financial instrument, so we have got three standards for financial instrument, which is Ind AS 32, Ind AS 107 and Ind AS 109. And I say all the time Ind AS 109 because Ind AS 32 is only a definition which we are going to discuss today, and again limited application but very important to understand the definition. Then you have got Ind AS 107 presentation, nothing, we are not going to talk because there is nothing, no questions on that, nothing, just theory. But this is what we are going to focus, recognition and measurement. Okay, now you imagine if I tell you a tiger is chasing a deer. You can imagine? Okay, now I say the tiger has caught the deer. Now what picture comes to your mind? Something like this. Correct, no? See, because when I say tiger has caught, it will never catch its tail or leg, it will catch its neck. Now if I say this is you, tiger is you, deer is Ind AS, what is the neck? Neck is your 109. I am telling you, just understand the concept of 109. You feel lot much empowered because you are say 20 or 30% you conquer this. If anybody you can expect you to ask any questions, it will be on 109. Alright? So let us spend more time. Let us not do hurry-burry, because if we do some hurry-burry, we might miss it. We will understand the concept thoroughly. No room for any doubt. Clear? Okay, and that too, what is this? It will catch what? It's called this thing, no? Tube for the lungs. Okay, and that is nothing but the classification theory, what we are going to discuss here today. So pay your full attention for today's discussion on the classification theory. Very interesting. Okay, so Ind AS 109, I can compare it with only two standards. With Ind AS 110 for the vastness, it is a vast standard. If you see, look at the questions, 70 questions are there. In study material questions, too many questions they are given. We are going to solve 72 questions. I can compare it with Ind AS 115 in terms of beauty and its importance. My favorite standard is Ind AS 115. I don't know, I told last time also. I like that standard, it is a different. But this Ind AS 109, it's like it has taken the beauty from your 115, it has taken the vastness from 110. On its own, it has got its own complexity code. It looks very complex from the outside. The definition, the classification rules, and it's highly attractive. Tomorrow bank, when I talk about the bank, what is going to come? Ind AS 109 is going to come, because there everything is a financial asset. So you should be very clear about the definitions of financial instrument, the classification and the accounting of the financial instrument. There is embedded derivative is there, many stuff is there. Clear? So pay your full attention, no scope for doubt. Okay, why do we need a classification called a financial instrument? Say we have seen, no, in the morning session, we have seen one item called a financial asset. Why do we need that classification? Tell me, think. Why? What is the purpose? How it is going to help me? Once upon a time this classification was not there. Maybe some 20 or 30 years back. Today that classification is mandatory. What purpose it is going to serve? What do you think? See, again, I said no, critical thinking means you have to let your imagination flow. Think. How? How it will give me a better picture?
For few stakeholders, the loan might not be the main criteria for something. They are decision making. So when they compare, like when they want certain items, they might need only bank or they might need only trade receivables for their decision making. But if we merge everything, they don't get the right figure.
But why? What is that? Like, see, if they want bank I will give no somewhere. Why I have to classify something like financial instrument, financial asset?
If financial instruments are directly related to money.
Directly related to money. Correct. You are coming to the point. You said something very relevant. It is related to money. So which is not, if you see the characteristic of financial assets versus PP, intangible asset, goodwill, you have one very clear distinction called money. It has something to do with money. Now for this we have to understand, why do we prepare financial statement? For whom we prepare? Okay, who is the stakeholder?
There are many.
Many, but who is the one we have in our mind when we prepare the financial statement? Yes, agreed, it's called a general purpose financial statement. There are some 7 to 8 stakeholders like government, you have general public, employee, but who is the one who is really interested in my financial statement? Huh? Investors and, okay, for this, for whom? Now to answer this, again I am going to ask one more question. What is the soul of the company? What is the soul of the company? Life of the company, blood of the company. If that is not there, company is dead. What is that? Money. Clear cut. Liquidity crisis means company may be highly profitable, but you have got liquidity crisis, you are gone. Money is the soul of the company. Remember, everybody's life, every company's life. You need to have money, otherwise you can't, see, you can't pay salary to your employees. Will employees remain? And it has a effects which you can't prevent it. So you need to get a loan from somebody, nobody is able to give. So finally you are left with no choice other than filing for bankruptcy and closing down your business. Now, if where the money is going to come, will is going to grow in the tree for the company, or some what's that, God is going to give, or money is going to lay the eggs? Where the money is going to come? Money is going to come from two important sources. It's called capital and debt. Remember, we know that. I am trying to just connect with the concepts. See, the money is going to come from two sources in the form of capital and debt, and the suppliers of capital and debt, you are my investors and my creditors, are very much interested to know your liquidity position. They are very much interested to know how do you manage your cash. Followed? So the classification, on what basis this classification would have been done? Tell me, what do you think? If I say classify something as a financial asset, what may be the basis for that classification? What do you think? You say liquidity? Will you say liquidity? It's not liquidity. What is that? What is that nature of financial? What do you mean by that?
Their power, control.
Think. You try.
Equity holders control.
Not equity holders control. What is the basis for classification of any asset as a financial asset? Is this financial asset? Is this water bottle is a financial asset? No.
Classification of
Liquidity is the basis for classification? No.
So classification is like,
Classification means you have got you have taken a loan. Whether that loan is a financial asset or not financial asset. On what basis you classify?
cash.
Okay, if you say cash, you have TDS refund. Is that TDS refund is a financial asset? Why? That's what I am asking. On what basis you classify? Sorry? One and the one word. It is not liquidity, not risk, not materiality. Remember and put it in your mind. There is something called a contractual right or obligation. You need to have a contract signed by two parties. So entire classification of a financial asset or liability is based on a contract. Clear? Contract. See, I have taken this premises on rent. On what basis? Through a contract. Contract should be there. On the basis of, see, TDS refundable. Do you have a contract with government? No. That's why I don't classify it as a financial asset. I am going to get the cash, but it is not a financial asset for me. Followed? So in SFM we have got two, I told morning only, okay, this point came earlier. Okay, so you have to study when at least when you revise, before you again revise Ind AS 109, study security valuation and your derivative chapter. So you will appreciate these concepts better, 109 better. Okay, so now what we are going to study? We are going to cover some 74 questions. Financial instrument basics we are going to discuss today. Then recognition and measurement of the financial assets, financial liability, compound financial instrument, impairment derecognition, derivative and hedge accounting. Only 8 aspects. And you understand the flow also. This is definition. See, without talking about this, I can't talk about this. I can never explain you. Why? Because first should I explain what is financial asset, no? Then I can say how you should recognize and measure. Now, without financial asset recognition, how you can do the impairment? How you can derecognize it? See, that means there is a flow. And it should go in that flow. You have to remember this flow. Because any questions coming in the examination, you should fit it where this is from. It should be one among the 8. Nothing extra, not the 9th one. At least, because again, I don't give you absolute guarantee. I can say 90% of the time, whatever questions you are going to get in the examination, it will be one among these 8. So, very first thing is, try to get connected. I got one financial instrument question. Where this is from? Is this from the definition part? Is this from the asset part? Is it from derecognition part? This is what you should do. Clear? Okay. So, first we are going to talk about the definition of the financial instrument, where we are going to talk about the instruments, derivative, financial asset, liability, equity, preference shares, exceptions and something called the own use exemption. This is the subcategories. So, today I will be sharing you the PDF version of all this. See, it is your choice, but I highly recommend you prepare a notes of this class theories, so that any time you solve any question, just quickly go through. You can go through my PDF also, you just glance, you can go through, but it is better that you prepare a notes of your own for these theories, whatever I am going to share. Clear? Okay. So, what do you mean by financial instrument? The standard says, look, financial instrument is any contract that gives rise to a financial asset for one entity and the financial liability or equity to another entity. Simple definition. And this definition is going to explode now, because to understand this definition, I should understand what is the financial asset, what is the financial liability. That all things one by one will go. Clear? The definition of financial asset is clear, or financial instrument is clear. Instrument means it is a contract. This is called a financial instrument. Instrument. Remember, there is a distinction between instrument and an asset. Instrument is something common. For me, it is an asset. For you, it is a liability. It is a liability or equity. Or for you, it is an asset. For me, it is a equity or liability. It cannot become asset for both the people. It cannot become liability for both the people. Debit, credit, offset, clean. Clear? All that is clear? Okay. So, before I explain you the concept definition of financial asset, I will explain you the concept of derivative. I said no, because if you have not studied derivative chapter, you will find very difficult to grasp the definitions. So, what do you mean by derivative? What is the definition of a derivative? The derivative is any product or a contract whose value is to be derived from the value of one or more basic underlying assets, shares, debentures, etc., which is going to change. This is called a derivative. Derivative, name itself suggests, simple, no? What do you mean by derivative? The value is going to get derived from something else. That means inherently it has got no value. It has value because of something else. Now, what do you mean by derivative contract for the purpose of accounting? Standard says, look, if any of the contract you want to say that it is a derivative contract, then it should be meeting all the below conditions. One, the value of the contract is going to change because of the underlying. That means it is not fixed, it is going to change all the time. On what basis? On basis of something else. There is no investment or very small amount of investment, and the settlement is going to happen in the future. Settlement is going to happen in the future. Okay, tell me. Okay, there are 4 types of derivative contracts, which again you are going to study in SFM. Again, when it comes to FR, for you this is very relevant. Forward contracts. Options, there is only one question. Swap, there are no questions. Future is something like similar to forwards only. Now what do you mean by forward contract? Tell me. What do you mean by forward? There are only 4 types of derivative. There are more types. Okay, what are those? There is something called a basket, warrant, swaption, leaves. Not relevant. It is one or the other form of these 4. So across universally, globally, there are only 4 types of derivatives. Clear? Now, what do you mean by a forward?
We enter into a contract agreement with the other party to sell or buy
at certain price in the future. Very simple. Do we enter into any derivative contract in our day-to-day life? Can you give me some examples of derivative contract?
maybe
Forward contract.
food with
Catering food, lot many. See, tomorrow you have to travel somewhere. Okay, you have to travel to Delhi. You book a ticket today only to travel after 3 months. Is it not a forward contract? You place order for your birthday party for food. Is it not a forward contract? So don't think that derivative is something very big. Derivative is very simple. And I will show you accounting. You think, sir, what is this accounting? Such a simple thing. Where the complexity lies in derivative accounting? Derivative accounting, complexity do not lie in accounting. Complexity lies in calculation of the profit or loss, for which you should know SFM. Accounting is very simple. Accounting entry is either asset account debit to income or expense account debit to liability. That's it. One among the 2 entries. Very simple. But did I make a profit or loss? Yes, that I should apply the SFM concepts. Okay, so to give an example, like today is January 2019, somebody has grown some vegetables. He is not sure. He is not sure whether the prices will be 120 rupees or 10 rupees. Followed? In say 3 months time, when the harvest is ready, he is not sure. Now remember one thing, all the derivative contracts are entered to hedge against the future uncertainty. If uncertainty was not there, why should I read a derivative contract? If I know for sure that I am going to get 120, why derivative? Why forward contract? How I can mitigate my risk? I enter into a contract. I tell someone, look, I am going to sell you 100 tons of say onion or whatever at 50 rupees per ton. When? On 31st March or whatever, April or June, somewhere in the future. And both the parties sign one contract. That's it. It is a derivative contract. What is the nature of the contract? Forward contract. Clear? Now, why did this guy enter? He must be thinking, okay, prices might go to 80. He must be a speculator, or he must be a hedger. He must be a manufacturer of some food product for which he needs onion. He also doesn't want uncertainty. We don't know. 2 parties enter into contract to buy or sell certain items in the future. That item can be anything. It can be a commodity, it can be a forex, it can be shares, it can be anything. Clear about this? Now, what is futures? What is futures? Exactly, same thing, same contract. I will sell you 100 tons of onion, but where the contract is entered? See, the first forward contract is called over the counter contract, OTC. That means somebody comes here, we sit across the table. But future contracts are entered in the stock exchange, in derivatives market. That's it. So from accounting point of view, you don't have any problem. There is only one question on the futures, that too under hedge accounting. Leave it. Now, what is options?
option to buy or sell.
Now who is having the option to buy or sell? Now he gives, okay, it can be derivative or it can be direct, whatever. He has got a right to sell or not to sell. Who? This guy. And this guy has got an obligation to buy if he is going to sell. Followed? Understood the difference between futures and option? In futures, both the parties have got an obligation. But in option, one of the parties is enjoying an option to do or not to do. Why? Why this guy should agree? Will you agree? Will you take this person's position?
No, there will be a premium.
The point here is, which is missing in the forward or the future, is there is a concept of a premium. At upfront, this guy pays a premium. It is something like insurance contract. You take one health insurance. Did you enjoy an option to claim or not to claim? Do you enjoy the right to claim or not to claim the health insurance? But if you claim, will the insurance company has an obligation to settle? Yes. Why insurance company is doing this? Premium. So option is nothing similar to your premium. I am telling you in a simple version for your easy understanding. Clear? Okay, but you should be very careful here because there are some questions on this and you should be knowing about this. There are two types of options called the call option and the put option. What do you mean by call? What sounds like? Call means buy. So I have an option to buy or not to buy. Put means sell. I got an option to sell or not to sell. Now who is that guy who is having the option? He is called option holder. And the guy who is having obligation is called option writer. So you will find a holder as well as writer both for call as well as put. Accounting is simple. Again I am telling you the same thing, reiterating that these concepts should sit in your mind because questions will come. Somebody said that Samco Limited has entered into a return put option. Now you should calculate that. What is my position? And you feel like SFM only, the way you can when you start calculating whether you have made a profit or loss. If it is a profit, your accounting entry is accounting assets to income. If it is a loss, expense to liability. That's it. Clear? And what is my swap? The last one. Now you wanted to sell him onion. This guy wanted grapes. So what you do now? First you say, okay, you say I will sell you grape. But I don't have grapes. What I do now? Now I go to the market and find someone who is ready to sell grapes to me. That means I buy grapes from this guy and sell onion to him. Then you can tell, no sir, if that is the case, why you have to enter into contact with this guy? You could have entered with the same person, no? You can tell me that. Okay, but when the time I entered, maybe this person was not available in the market. There was no buyers for onion. So same example I will explain in the terms of debt and debentures. Okay, like you have invested in the fixed rate of debentures. What do you mean by fixed rate debenture? You are going to get the fixed interest. Now you are thinking after 1 year, oh, I made a mistake. The market prices might rise. So I am losing, no? If the market prices are going to rise, are you going to lose or gain? When you have invested in a fixed rate debenture, you are going to lose. But if you have taken a loan, you are going to gain. Now, since your investment and you wanted into a variable, so what you can do? You can enter into a swap contract. Again in SFM, you have got something called interest rate risk management. Same, the swaps are going to happen. You exchange fixed interest for someone, get variable interest for someone. So this is called a swap contract and it is a derivative contract. Clear? Understood about the basics? Clear, no? No doubt, right? Okay. Now I will give you 3 examples. Understand it and you have to think now. Now you are an entity and you have given a loan to someone for 1 crore. What is the accounting entry you pass? Will you pass accounting entries? Okay. What is the accounting entry you pass? Say debtor, borrower account debit to bank. How you are going to classify it? Where you are going to show that borrower? Where you are going to show the borrower? The very first, see, in traditional accounting, whatever you would have said, but in going forward in days, the very first question you should ask me, sir, today loan is given fine. How that guy is going to settle the loan? This is the very first question should come to decide how you are going to present. Now I will tell you the settlement is going to happen in cash, land, own equity shares. Now I will give you one exercise. You take situation 1, cash, and prepare the balance sheet extract. You take situation 2 and prepare the balance sheet extract. in rough book. You take out the rough book and prepare the balance sheet extract. You know, do you have a reference? Do you know how the balance sheet looks? I have given you already, first page. There are like items are there. Now you have to prepare an extract. You passed an accounting entry. What is the accounting entry? Loan account debit to bank, correct? How you are going to show this loan in the balance sheet? How you are going to show this loan? Will you show on the asset side or liability side?
Asset side.
Asset side. Where? Right. Always not right. Because more you write, more you understand. No rough book. Huh? Okay, you can manage it. Tell me, how did you classify it? Okay, where did you show if the settlement is going to happen in cash, where did you show it? Where did you show? Sorry? You can assume that okay, it is a non-current. This loan is whatever they are going to repay you after say 3 years or something. Okay, very correct. That's the very another question you should ask, whether it is a current or non-current. Okay, I say it is a non-current. Then when under non-current assets, financial assets, you show loan given. If that settlement is going to happen in land, why minus PP? Settlement, no. How you are going to do? It is not investment property. You are given a loan, no, and that guy is going to repay you not in the form of cash, but he is going to give you his land. And when we know that, today only I know, when I entered into a contract. When I entered into a contract only I know that that guy is going to give me the land. So where you will put in the balance sheet? Under PP. Did you buy? Did you have? Okay. Under PP, what you will show? What you will say? But it is not. There is no land, no. As of now, it is only a loan only. When the land and building, correct? When? After 5 years. At the time of 5th year, you will pass an accounting entry, debit land, credit loan. Which advance given? Now my basic question is it a financial asset?
No.
Why? Now today what is that? What is the classification today? See, land I am going to get after 5 years, sir. Remember, I am going to get the land after 5 years. Today I have given a loan from my bank account, say 1 crore has got debited. Under no circumstance I can deviate from an accounting entry called loan account debit to bank. That is the only accounting entry I pass. But my second challenge comes, and the balance sheet, where do I show this loan? The first case you said it is cash, it is a financial asset, I agree with you. But in the second case, where do I show?
So it should be still financial assets because we have the right for what is the contract.
Okay. You say still financial asset? No, I say it is a capital advance. You have given an advance in the name of loan for someone to buy some asset. Doesn't it look like that? See, through contract you can write anything. See, again, in Indians I tell you one thing very clearly. Today morning also I told, if the contract is very plain and straightforward, What you are going to do is what you have done in first POC. But something happens. Now, when bank gives you loan, bank will ever enter into some contract like, okay, settlement is going to happen in the form of land? Never. No. Have you seen any such type of loan? Any money lender will give you loan and say settlement is going to happen in the cash in the form of land or jewelry? Never. You go to Manipuram Gold. How the settlement should happen? You keep your gold this thing and you take the loan today. How the settlement is going to happen? Pay money. Manipuram, when they will confiscate, when you are not repaid. That means in the name of loan, what did you do? You have given advance to someone. So it is not your financial asset. It is an advance for buying an asset. Followed? Now, what if you are going to issue own equity shares? How loan given? You are given a loan today. Yes.
Land. After 5 years, the borrower will give the land.
He will give his land to me.
Okay. In the middle, can he, like, if that is there should be a contract.
Contract. Obviously, I will go everything with the contract. Now I say that's fine. Everything I go with the dot contract. Why? Because I can go and enforce in the court of law.
No, but capital advance classification will be
In my financial statement. Okay, I will show you that. Then you will be more clear. Okay. Now the third option is other non-current assets. Yes, it will come under not financial asset. It will come under other non-current assets. In your classification, you have something called other non-current assets. It will come there. And the third is own equity shares. It is going to settle by the own equity shares. In that case, what is going to happen? Okay, yeah, we'll see that. Okay, in the first case, I am going to pass an accounting entry: loans and advances given to bank. Correct? Agreed? Now settlement is going to happen in cash. So at the end of the year, in my balance sheet, I will show under assets, non-current assets, financial assets, loans and advances given. Clear? You have any doubt? Now if you ask me, sir, why we are putting under, you are able to see screen?
yes.
If you ask me why we are putting under this, because I say you have got a contractual right to get the cash. Clear? Okay, let me go to the second scenario where the settlement is going to happen in the land.
So this case, the contract itself says that the settlement will be.
Contract says, it is not that you enter into some other contract like that. No.
No, I'm saying that what if by the contract it says that the payment will be made in cash. If in case of staying there, the land will be paid.
Now again, you have to apply now. Think about the substance. Now imagine, okay, something like this. The land is, you are given 1 crore rupees. What is that called? Loan. The land is worth 10 crore. Then, yes, very good. A contract might have a clause that the borrower is going to repay in cash. But if at all he is not going to repay in cash, I am going to confiscate the land. Clear? What is the loan taken? 1 crore. Land is worth 10 crore. Tell me now. Now tell me, if you are the borrower, what you will do?
In that case, I will take the 9 crores.
No. See, okay, let us, no confusion. Now, are you a lender or a borrower? Okay, you take the position of a lender. I am the borrower. You have given me a loan of 1 crore. Now, the contract says, like he said, there is some slight variation. What is that variation? It says that, okay, this 1 crore has to be repaid at the end of 5th year. If not, then I have got one land in some prime area that will be confiscated by you. What is the loan given to me? 1 crore. What is the worth of that land? 10 crore. Now what do you think? What I am going to do? Will I pay you cash or will I allow you to confiscate my land?
Cash.
Pay cash. Then what is your classification? Financial asset. Because you know that you are going to get cash.
No, I think this question was
Cash or land. Again, when you say cash or land, you have to go into the substance.
risk control.
Yes, but you think, that's what I said, accounting is common sense. You have to think what is going to happen practically. You need to have that imaginative quality. You have to imagine what somebody will do. What somebody will do. Okay, if the land is worth 80 lakh rupees, what somebody will do? I'll keep quiet. Okay, take it. That means you are also sure on the day of contract only, I am not going to get the cash. because other guy will never pay me cash.
We will never let go of the 10 crore rupee land.
He will never let go. If at all that day comes, I will take a loan from bank and give it to you, but I will never let that land go to you. So like this, it's like a pledge. That's why I am telling you, we have to get into the substance. Every contract clause we have to understand and see at the time of contract entering, when you sign the contract, what was the intention, what might happen, because accordingly my classification is going to change. Okay, in this case, see, 1 minute. In this case, what I am going to show, when the settlement is going to happen in the form of land, I will show under assets, non-current assets, other non-current assets, capital advance, not financial assets. Yes, you are telling.
What if the contract? What if this amount is 1 crore, so the land value is 1 crore? So it's just like.
Now again your question is land value is also 1 crore. This is also 1 crore. Now you should go with the past business practices. You have to see if your business is giving land. Generally, what you do? Will you take back the land or will you take the cash? That is what you need to do.
If the person is unable to pay the cash.
Doesn't matter. You will sell the land and get the cash. No. If your intention is not to get the land, that's what. How do I know as an auditor? I have to look at my past practices. The standard says very clearly. See, when you have got clarity, if you don't have got a clarity, look at your past business practice. If you have been regularly buying land, that means your intention is clear when you give the loan.
I say accounting should be done as like as how the pledging will be done.
That's what you have to understand the substance. What you need to see, why did you give that loan? Was it a loan or was it an advance for capital advance to buy the land? Now, does it make a difference now whether it is a capital advance or this? It makes a difference, and people are going to play through contracts because I don't want to show it as a financial asset, or the land advance I want to show as a financial asset, telling loans given to somebody. Standard says no.
Why would someone not show it as financial assets? Because
They might have their intention, no?
it increases.
No, they will show, no. You see, if it is an advance for land, it cannot become a financial asset. But I will show under financial asset and go to the bank and say, look, I have got a good financial asset.
One example of that. Why would someone do that?
That's what, no? I will show a better picture of receivables.
But financial asset is more liquidity and it's.
Need not be, no? No, again, my position, suppose you go to the bank. You say, sir, I have got a land versus I have got a debtor who is going to pay me 1 crore. When the bank will be more confident? Tell me. Cash, why? No, not land, no. Because land value is not fixed. Tomorrow, what if land value goes down? But your contract value is always fixed, no? You will always get 1 crore rupees. But can you say, after 1 year, I will get 1 crore for my land?
No, land is actually more.
No, that you.
1% in land. But debtor, if he goes insolvent.
That is all business risk. That is a different thing. But even though he is going to get insolvent, you as a creditor has got a first right over his estate. How much you can get money from his estate? 1 crore. Not single rupee more, not single rupee less, provided that much money is there. That's why financial asset gives you one guarantee that if I show 1 crore, I am going to get 1 crore. But if I say land 1 crore, it is not a guarantee for me. Land can be 50 crore, land can be 10 lakhs after 1 year. But financial assets are not like that, no? Financial assets means what amount you show, that amount you are going to get.
No, land value will never decrease.
Again, okay, since you asked this, Hospete, one of my relative was there. Once upon a time, they had got a quotation for, they had some land and some property and all. They were quoting for 2 crore rupees for one small piece of land. Somebody wanted to buy. These people thought, okay, land, always prices are going, somebody has sold at 5 crores, and all those calculations went. The mining stopped in Hospete. That all Karnataka, this thing happened, no? Now who is asking? It's not worth 50 lakhs, no? So again, it all depends. I said, no, value depends on perception. Imagine if this spot is going to become tourist, this thing, some Udbhavalinga is going to come, something like that. Tomorrow, left and right people are going to come. This land value is going to skyrocket. Why? because you can put up one hotel here. So it all depends on that. But can you pinpoint and tell this is the amount I will get from the land? No. But from a debtor, from a financial asset, you can pinpoint and say this is the amount I am going to get. When? On that day. No, I can go to the court. But for land, nothing like that. For PP, nothing like that. So that is why very important this classification, because you can misguide investors. You pay capital advance but say financial asset. Misguiding, no? Okay. And if you have going to settle it in your own equity shares, then loans and advances given to bank will be okay. Now the question comes, 1 minute, just a minute. Okay, now the third scenario, we'll talk about the third scenario. You have given 1 crore, how the settlement is going to happen? You are going to get your own equity shares. Clear? Own equity shares. Like you have taken a loan from Karnataka Bank. Karnataka Bank shares you are owning. You don't pay the money to Karnataka Bank, but you say, sir, I have got Karnataka Bank shares with me, please take this back. Possible? Possible, no?
Already I am holding the.
Already you are owning, and settlement is going to happen in the form of shares.
This is kind of indirect buyback.
Indirect buyback. That means in the name of loan, you are buying your shares back. When you know that, on the day of contract only you know that. Now question comes, very important question you have to ask. Sir, how many shares I am going to buy? Very important, remember. It can be say fixed number of shares, or it can be something variable number of shares. Clear? First scenario you are clear. You are given a loan, money is going to come by cash, financial asset. Second scenario, you are given a loan, no money is going to come back, you are going to get a land. It is not a financial asset for you, it is a capital advance. It is not non-financial asset. It is non-financial asset. Clear? The third scenario, you have given a loan, somebody is going to give your own shares back to me. It is a very clear-cut case of a buyback. But again a question comes, how many shares I am going to get? The standard says, look, if you are getting 100 shares, then it is a buyback. If you are getting variable shares, what do you mean by variable shares? I have given you 1 crore shares, no? 1 crore rupees. I have given you 1 crore rupees loan. Now the repayment happens based on the market price at the end of 5th year. Then can I tell you how many shares I am going to get? I cannot say. That means it is a variable shares. So standard says if it is a fixed number of shares for fixed consideration, then you are going to classify as equity. Under equity you are going to deduct this money in the balance sheet. When you give the loan, you will not say loans and advance, you will deduct it from your equity. Understood now? Concept is clear?
The third one is always going to be the transaction with your shareholder.
It's like your transaction with your shareholder, simply you are told one loan. It's not a loan actually.
Intention was buyback.
Intention was buyback. But you said loan. That's why they have given one universal definition. See, because I cannot simply directly jump into definition without explaining you this example. I want to tell you one universal definition, beautiful definition, which is applicable everywhere in the world. Okay, so now if it is based on the market price, then I will show under financial assets only, loans and advances given. Clear? You are going to buy back your own shares. Not fixed, variable. Yes, it is a financial asset form. Why? Because equity shares are my financial assets. Okay, so I hope you are clear. Now let us go to example.
Based on the market price, that will also can be considered as buyback.
Standard says no, because now they are telling you are using your shares as a currency to settle it. When you are going to issue fixed shares for fixed cash, and when you know that fixed shares, fixed cash, today, if you know it today, that means it is a buyback. It is an equity transaction. It is not a loan transaction. It is not an asset transaction. It is not a liability transaction. Yes.
Is there no regulation like how much
Sorry.
loans to be given to shareholders? Any limit? So it's like just to reach that buyback regulation, like that 24%.
Okay.
They can give all that in the form of loan and then take it.
They can do, but accounting will not allow. No, it will. You have to pass it through any loan given. You have to pass it through some definition. You have to pass it through a definition. See, now how much I can give, that is a law. Law is going to govern it. Whether I can give loan to the shareholders and all. But when it comes to accounting and representation, you have to present based on your accounting principles. Not sure, but let me check. It's the law. You are asking from law perspective, no? Okay, let me check.
Just to manipulate that.
Understood. Yeah. Okay, now let us understand the second example. Okay. He is asking, is there any limit for the loans to be given to the shareholders in law?
No, there are no limits. But whenever loan is given to a shareholder, if it is more than 20%, then it is considered as dividend, and then it is deemed dividend.
Yeah. Anyhow, let me check. Let me get into it. Let us not deviate because this.
It's taxed actually at the rate.
Okay. I'm with taxation and all. I not got into. Anyhow, I'll just check this part. We'll discuss it after. Okay. Now, first examples are clear. Crystal clear, no? No doubts, no? Okay. Now we'll go to example number 2. Now, on 28th of March, please understand it. You entered into a forward buy contract with a company to buy L&T shares at rupees 100. Now, on 31st March, the market price of L&T shares is 150 rupees. Is it favorable or unfavorable to you? Are you happy or are you sad? You are this person.
I'm happy.
I'm
happy.
You are happy? Why? Okay, first of all, what is this contract? Derivative. You entered into a derivative contract on 28th, and on 31st March, you are very happy because immediately after 2 days, the share price has gone up. So you are very happy, right? So what is the accounting entry you pass? You say forward contract account debit to income. Agreed? Why? Why this is this a financial asset? Yes. Why? Because that company has to pay you cash, no? That differential amount they have to pay you in cash. So it is a financial asset. Now in the balance sheet, what do you show? You show under assets, non-current assets, financial assets, forward contract asset 50.
But when do we pass this entry?
On 31st March. Because on 20th I don't pass anything. Why? Because I didn't pay anything.
So the differential amount, whatever is there, that will be the amount on 31st March.
31st March.
And the forward price.
That is my gain. I am in a favorable position.
Yeah, because we have to see that difference. So we take 31st March amount.
31st March amount, and I will see what is my position. I am in a forward buy. So I am in a favorable position.
Yeah, that 150 keeps fluctuating.
It keeps fluctuating because it is a derivative contract.
Yeah.
Because the price of that depends upon the share price of the L&T. Yes.
So we're not recording anything on 28 months.
No, we will not record because okay, what accounting entry I should pass? Tell me.
No, just say.
No, because why? Because there is no gain, no loss, no.
But in that case,
Yeah, tell me.
you're not recording the transaction anyways, but how can you just record the gain? Like,
When did I record? When did I record? 31st March, correct. Because see, today you entered into a contract with me when 28th March. You said you will buy something from me at 100 rupees. Within next 2 days, the prices have gone to 150 rupees. Can you get that, catch my neck and get me that 50 rupees? On 31st March, are you sitting in a profit or loss? Profit, no? So should you not pass an accounting entry for the profit? That's the accounting entry we passed, no? Profit. This is called derivative accounting. That's what I said. Derivative accounting is very simple. Only one accounting entry. Because you are sitting in a profit and that profit money is receivable to you. Can I say, no, I will not pay you? Can I say?
No.
Why?
But it is not realized. We can
Correct, not realized. But can I say I will not pay you? Why?
It's an obligation for the.
Okay, if I say I will not pay you, what you will do?
Then go to court.
You go to the court. What court will say?
Yes.
Pay. Why? There is a contract. Everything starts with the contract. So on 31st March, it was a liability for me and it was an asset for you. Ulta, if you would have entered into forward sale with me, you would have cried because it is a liability for you. For me, it is an asset. Followed my point? Okay, so my accounting entry will be this because you are in a favorable situation. So you say it is an asset, and in my balance sheet, I will show it as a liability. Clear, Mahesh? Okay, now you think about example number 3. Yes.
Why are you not passing the interest when I didn't get that?
Which on 28th? Okay. On 28th, did you pay any money to me? Did you pay any money to me? Or did I pay you any money? Nothing. See, suppose you enter into a contract with some caterer. You say somebody, you call them and say, sir, I want food on say 31st March or say 10th of April, whatever. Will you pass an accounting entry for giving that call? What it is called? That agreement is called what? Forward agreement is called what? Can you give some other name? Okay, derivative. Any other name? Layman language. See, forward derivative is a big terminology which some ordinary person is going to become afraid. If you go to audit, what is that called? When you place that purchase order, what is that called? It's called a commitment. So you will never pass any accounting entry for commitment. And in India's language, it is called executory contract also. That means nobody has performed anything, no. And on the day of contract, there was no gain or loss. Did you make any when you signed? Did you make any gain? No. Did you made any loss? No. Why? Because if at all you will make any gain or loss on the day of 28, you will never sign. Or imagine you are going to make a profit. Will I sign? Knowingly that I am going to make a loss instantly? No, that means on the day of contract, on 28, there is no gain or loss for both the parties. The loss or profit meter is going to start from next day. So that is called a mark to market. Every time I will find out the fair value, the difference between my previous value and this value, I will see what is my position. Am I happy or I am sad? I am happy, I will pass this accounting entry. I am sad, I will pass an ulta accounting entry, expense account debit to liability. You are clear now why I did not pass? Because that is my definition, no investment. Suppose if you have to pay me some advance, what is the accounting entry will pass? For this contract, if you have to pay me some advance, say 500 rupees, what is the accounting entry you pass? You pass an accounting entry, advances given to bank. But nothing happened, no? In this contract there is no advances. So that is called a derivative contract. Clear?
So can I just once again? So like on
28th March.
you just saying that
I will buy it. When? Maybe in April or June or somewhere.
So you just writing that profit amount at the end of the
Reporting period. Why? Because I have to finalize my accounts. If it was not reporting period, then I need not do it.
okay, this commitment, it's just a commitment.
It was a commitment on the day of contract, but the next day it became my obligation.
So it's just the written contract has been they have passed the written contract on 28th March.
28th March, yes.
That doesn't bind the transaction. So not about anything, just on 31st March, the profit is recognized.
On 31st March you are going to recognize the profit, and it is an unrealized profit. You didn't receive anything, no. If you have received, what is the accounting entry you pass? Suppose let us assume that on 31st March I will say enough man, this contract is enough, I will pay you. Tell me what is the amount I have to pay. 50 rupees, no, I will pay you. What is the accounting entry you pass? Bank to P&L, that's it. There is no more asset called this. Financial asset is there. What is that financial asset? Bank. See, simple, huh? I am telling you again, don't think that financial instrument is difficult. Accounting entry, be clear about the accounting entry. You have to be clear about the rules. It will go like this. Spend time, you and go today home, study whatever we discussed. Clear? Okay, let me give the third example and the last example. Now, Karnataka banks gives rights shares. You know rights shares? Okay, they have given you some shares and say you give me some money, I'll give you less than the market price. So, who are the option holders here? Shareholders are the option holders. Now, at what price? I say at 100 rupees or at a market price. Now, if I say at 100 rupees, then it will go into other equity. Why? Because fixed amount of cash for fixed number of shares. I am going to receive fixed money from my shareholders for issuing fixed number of shares. But if I say you have to give me market price on the day of transaction settlement, I might issue fixed number of shares, but the amount I am going to get is a variable. So, this is equity, this will be asset or liability.
Where does this go?
Other equity.
Under which?
Under other equity is the head. You will going to create one different head called any head you are going to give, any name you will give that money collected for the sake of issuing. Under it's not financial asset, no, it's an equity, right?
Other non-current assets.
Other non-current assets. Okay, I'll tell you where the classification is going to come. Let us go to the definition, then I'll discuss about this. I'll give you the accounting entry because I have not thought about the accounting entry. I'll give you the accounting entry for this. Okay, now first we'll discuss about the financial definition, financial asset definition. Now, what is a financial asset? And you have to know it because you have to reproduce it. Financial asset is any asset. They said any asset. That means my PP cannot become my financial asset. Then what is that any asset? Which is cash. Why cash? Cash is money. That is a financial asset. Then equity instrument of another entity. You have invested in the equity shares of another company. Do you have under contract? Did you invest? Yes. But do you have got the right to get the money? When? Only on the liquidation. But these are the two hard coded. They said, okay, forget about rules and all. Your cash and equity share investment are your financial assets. Clear? These two things are financial assets. Then they give one generic definition. It says any contractual right to receive cash or another financial asset from another company entity, or to exchange financial assets or financial liability with other entity under conditions that are favorable to the entity. Did you understand this? Tricky, no? Understand, try to understand. Spend time. This is clear? No doubt, no? Anytime I'll ask you, what is cash? Cash is a financial asset. If I say equity shares, what is equity shares? Financial asset. No need to apply your mind or what it is. But if you have entered into other contracts, like say you have given loans and advance to some party. Now question comes, when you have given that loan to third party, did you get the right to receive cash from the third party? If your answer is yes, that loan is a financial asset. If your answer is no, then it is a non-financial asset. I said the example of land. When you have got you have given a loan and you have got a contractual right to get the land, that loan is not a financial asset. Loan is not a financial asset. But in the first scenario, when you have given a loan and you have got a right to get the cash, that is financial asset or other financial asset. Maybe he will tell, suppose I have given a loan to you. Okay, you are the borrower, I am the lender. You have to tell me from my perspective. Now you are owning L&T shares. If you repay me through L&T shares, is it financial asset for me?
Yes.
Why?
It's a financial asset. I'm repaying.
Why it's a financial asset for me?
I'm repaying through another financial asset.
You are repaying through another financial asset. Land is not a financial asset. Got my point? Now it makes sense. That's why without example, if I straight away jump to this, no, you are going to struggle to understand this. Simple, you go with the example. Now in your mind it should come. See, accounting entry, irrespective of anything, even Brahma also cannot change. What is the accounting entry you pass on the date of giving the loan? Loan to bank. Simple. But the question is, in the balance sheet where I show it, under which classification I show. That is the prime question. For this I have to look for the settlement. If the settlement is going to happen in cash or some debentures or equity shares of other company, then it's a financial asset for me, because I have got a contractual right to receive cash in the future or financial assets from in the future from another entity. Clear? Or I have got a contractual right to exchange financial assets or financial liability under conditions which are favorable. Can you think of any example? Can you think of any example?
Selling shares, when the opposite party shares have higher value.
Sorry?
Thinking for example, selling shares, wherein the opposite party, when the borrower's shares are valued more.
Valued more. Okay. That will happen on that day, no?
Buying of shares at a lower price. At a lower price.
No, don't get into such example. Simple example I will tell you.
Any
Derivative contracts. Derivative contract. Because you entered into a contract, after few days you find yourself favorable. See, now yes, I understand you, a lot of things are coming to your mind. I encourage that. Yes, it has to come. You have to think of all situations. But be first conceptually clear about the examples what I give. Then you come up with, okay, what if that situation, what if this situation? Yes, you have to do it. That is critical thinking, right? But at this point of time, just connect with the examples what I am trying to give. Followed? So you have got a contractual right. Why? Because you entered into a derivative contract with me to exchange financial asset. That means you are going to get a cash from me when you are under a favorable situation. Clear?
So here, derivative contract on 31st March, we are going to put that in financial assets.
Under financial, I showed you, no? That classification I showed. Under that I was putting under financial assets.
But we are only going to write profit on the derivative.
Yes.
On 31st March.
On 31st March. Maybe it might change on 30th April.
So it's not the entire amount they want.
No, because you didn't pay, didn't receive, no? It will, when you do that entire amount on the date of settlement.
But we have the right for another 100 also, not just one.
When? On the date of settlement, no? Can you say now only you give me 100?
But isn't it asset for us?
No, how it will be an asset? You are, see, can you tell, no, give me now only? You have got a right, but when is that right you can execute? On the date of settlement, no? And if you are going to pass an accounting entry, will he give you for free? You have to pay cash also, no? Did you pay cash on 31st March for 100 shares? No. But what happened? You, on that 100 shares, you are sitting in a profit. If he pays you, gives you shares, then you pass an accounting entry, shares account debit to cash. Clear? Okay, so this is my definition of financial asset. Then comes the beautiful definition. Read it slowly. A contract that will or may be settled in the entity's own equity instrument. Contract, like you have given a loan. How the settlement is going to happen? In your own, in my own equity instrument, and that instrument, that contract is a non-derivative contract. A loan is a derivative or a non-derivative? Non-derivative. Very good. For which entity is obliged to receive variable number of shares. That means it is not fixed number of shares. I am going to get my variable number of shares. That means it is a financial asset.
Situation.
It is a financial asset.
Situation
3. Second example. Or a derivative contract. What is my derivative contract? Where I give an option, put option. You can sell the shares back to me. Correct? Now how many shares you will sell it back to me? How much I buy back? I don't know, it might change. Or it can be fixed amount, but how much I have to pay you? Derivative that will be settled other than by fixed amount of cash for fixed number of shares. When I give you a put option, what do you mean by put option? Option for you to sell the cash shares back to me. My own shares you are holding, you will sell the shares back to me.
But we recognize that also, put option.
Put option, I might have given you, no?
If I am the
There is one, very good. There is one exception to it, yes, for which some special accounting has to happen. If I have given you a put option, I have to recognize a financial liability.
correct.
Why? Because tomorrow, who is holding the option?
I'm holding.
You are holding. Can I say I will not buy your shares at the end of my shares at the end of year? No, I don't have any rights to avoid the payment of cash, so I have to recognize the financial liability. We'll come to that. Let us understand, focus on the financial asset first. Okay, now in both the cases, remember this is the same definition. You go and read the financial liability also. This part of the definition, ditto, full stop also same like financial liability. Clear? That means it is a derivative contract or a non-derivative contract where I am going to get variable number of shares or variable amount of money I am going to pay. In simple, in short, if I have to, okay, this is, but in exam you have to write this, you have to study this, same thing you have to study, 1 or 2 questions are there. Okay, it is easy. Once you understand the concept, it is easy. Now, in simple language, if I have to tell you, simple language, if I say whether a derivative contract or a non-derivative contract, what is derivative? A forward, swap, option, or what is a non-derivative? A loan. That will be settled in entity's own equity. That means tomorrow I am going to buy my own shares, which fails fixed for fixed test. What is fixed for fixed test? Very easy, no? Fixed shares, fixed cash. I will pay you fixed cash, I will get fixed shares. If this fails, it is financial asset or liability. If it passes, what it is? Equity. That's it.
So previous one,
Yes.
it has to be fixed number.
Which one?
In case of derivative,
That's what. Now, for a fixed number, other than fixed amount of cash.
no.
See, they are also smart.
Options, they cannot be variable.
Correct. That's why what they say. Correct. I give you an option. Correct. You, how many shares you are going to sell me? 100 shares.
And that should be fixed. In
Fixed.
options.
But how much money I will pay you? They say other than fixed amount means what? Variable. No? I will tell you what. You sell me 100 shares, but based on the market price on that date, I will pay you cash.
But option doesn't work like that.
I might have come. See, can you say any company should not enter into any some contract like that?
Then it's not option.
Then what it is? It's called a put option. I can enter. No, what? Who can stop me? Tell me.
But in put option, you have to say the
That is through whom? That is through stock exchange. I can enter into option over the counter also. No, I can have one-to-one contract. I can write anything there. See now through this, no, what they are trying to do. See, I am a creditor. I am a person. I make certain investments in your business. But I give you land and I say I have given a loan. The standard looks into all these things. Okay, you have given a loan or you have taken a loan. Finally, how the settlement is going to happen? Are you sure on the day of contract the settlement is going to happen in cash or your own shares? If it is cash, it is a financial asset. If it is shares, then you have to apply one more rule. Is it fixed for fixed? Yes, then today only it is equity, not after 5 years. Not after 5 years. From today it is equity. No, it is a financial liability or asset. Okay, we will solve the question, then you will get that clarity. But basically you have to understand these definitions. Clear? Okay. Next, in simple I said it is a fixed for fixed test is going to
so
fail.
it's not fixed for fixed. Then it is fixed for variable. So
It is a financial asset or a liability.
financial asset, what amount are we going to deduct today?
Nothing. It depends upon am I in a favorable situation or unfavorable situation.
The loan amount we are going to deduct.
No. You don't apply that loan part to the derivative contract. That loan example, you have to apply only for this. That loan, no, I said, you give her 1 crore rupees loan. That you have to apply only for this. That loan example don't apply for a derivative because there is not a derivative contract, no. I didn't give any option to you. You give me loan back or don't give me the bank. Not like that, no.
No, as it's like fixed to fixed rate.
Huh.
If variable is there, then we don't know the amount, how much we have to deduct from equity.
Mm.
What should be the amount.
No. In that case, if I give you an option, why do I give you an option? Why I should give you an option? Then you say, sir, you will pay me a premium. Will you pay me a premium? Yes, no. Otherwise, why I should take that obligation that when you sell, I should buy? Who is holding the option?
I'm holding the option.
Why I should give you an option?
Because you get premium.
What should I do with that premium? Is it income?
Yes.
No. It's a fixed for fixed. No, it's the equity. It's not my income. I have to show it in capital. I received some money from my shareholders.
The buyback of shares will be premium amount.
Whatever premium received is there, no? That will be equity. It's not my income. Again,
Okay, that premium
premium amount will be income, and I have got into a liability because tomorrow I have to pay you. That's what that part. What you are telling, no put option. There is one exception to it. We will discuss about. There is one question, very important question. We will solve that question also. Okay, so this part is clear. So if you are clear about this, then the financial liability also goes simply. Okay, now can you give me some examples of financial asset? Financial liability we will discuss tomorrow. Okay, because already it is too much. So we will discuss tomorrow financial liability. Can you give me examples of financial asset? Cash, equity shares.
debt instruments,
What debt instrument?
debentures.
Debentures where? Your investments. Then derivative contracts. Then trade receivables. Then loans and advances. Then bank balance. FD. Security deposits. All these are your financial assets. Okay, so if I give an example, so you have got trade receivable. That's why you see the format. You see all these items there. Investment in equity and debentures, deposits made. What are my non-financial assets? PP. You have inventory. You have ROU asset 116. Intangible assets. Prepaid expenses. Why prepaid expense is a financial non-financial asset? When you prepay some expense, what you are going to get? What contractual right you have got? If you prepaid some expenses, say electricity charges you prepaid, what rights you have got? To get money or to get the services? Service. So it will fail the definition of financial asset to contractual right to receive cash or other financial asset. It fails that definition.
So security deposits.
Security deposit is a financial asset because you have given a security deposit. What your contract says at the end of that, whatever cylinder deposit or whatever, what that person is going to pay you? Cash. He is going to refund you that money, no? So it is a financial asset. Now you are getting clear? Income tax refund, even though you are getting cash, it is not a financial asset. Why? You don't have any contract. Then advances given for supply of goods and services like capital advances, not financial asset. Why? Because you are going to get other than financial assets. Clear, no? Okay, so chalo. So equity versus financial liabilities we will discuss tomorrow. Very nice because it will take time. I cannot simply finish it. So we will continue tomorrow.